Welcome back to the Audacious Money Witch channel, where we talk about the magic behind the stock market. Quantum computing stocks have been flying high lately, with the market gaining greater conviction that quantum computing could potentially disrupt classical computing in the future. Investors are bidding up the share prices of some pure play quantum names into the space. However, due to their balance sheet health, I already cut two out just to save you the research time. I will particularly focus on two largest companies, IonQ and Rigetti. The promise of quantum computing. McKinsey estimates that the market size of quantum computing could reach between $45 billion to $131 billion by 2040. Quantum computing essentially strives to help us better understand and leverage the scientific world around us, which possesses a quantum mechanical structure. Quantum computers are still in their infancy, but we don't have to wait until they grow up to get a glimpse of the difference that they will make. We already have a few working examples of what quantum software can do, thanks to the ability of early-stage quantum machines and classical computers that simulate what is coming. International Business Machines said it now generates revenue from deploying quantum systems and services to more than 250 customers. IBM said it is using quantum systems with Wells Fargo to potentially improve AI technology, for example, by testing and implementing new machine learning generative models. IBM's quantum scientists have developed an algorithm for managing weather risk using quantum computer that IBM says could outperform classical methods. IonQ, a quantum computing company based in College Park, MD, typically uses simulated quantum computers during the early stages of a client engagement and actual quantum computers to validate results. We are exploring where quantum algorithms can benefit existing workflows in machine learning, chemistry, and optimization. The goal is to develop hybrid solutions that offer advantages over classical-only methods. One of the great challenges of the field is that fragile qubits generate errors as they tackle problems, with the error rate increasing as the platforms get larger. Qubits are the basic units of quantum computation. Google says Willow, the new quantum chip it announced, switches this dynamic, reducing errors with the addition of more qubits. It will be around 3 years before the error rate reaches the target, according to Google, and the company doesn't expect its quantum systems to reach full scale until the end of the decade. So there is no need to FOMO into these stocks right now. That being said, I am not going to stop you from making money. You can buy whatever you like.
Let's start with the unprofitable quantum computing plays, because the best performer of the ever, at least so far, is a company called Quantum Computing. That's QUBT for all you home gamers. It's up an astounding 588%. That's closely followed by two more quantum plays, D-Wave Quantum and IonQ. Don't ask me to explain the concept either. You need a physics degree to get your head around it, and trust me when I say that most of the buyers do not have one. While people have been talking about it for years, it's still highly experimental. But I do know stocks, and when you look at the history of QUBT, do you know that this was a beverage company until 2018 when it pivoted to being in software for quantum computing? Now, that failed to inspire much interest, so in 2022, QUBT acquired QPhoton, which is a developer of quantum photonic systems. Right now, they're building a semiconductor plant in Arizona to make specialized materials for quantum computing. And the stock seems to be running on the fact that they're on track to open this facility in the first quarter of next year. Through the first 9 months of the year, it only racked up $311,000 in sales. This is 6 years into the quantum computing pivot, people. Somehow QUBT is a $910 million company. excessive. D-Wave Quantum came public via a SPAC a couple of years ago, always reassuring. And it's also unprofitable. The last one, IonQ, is surprisingly an almost $7 billion company after more than doubling this month. They're unprofitable too, though IonQ is expected to reach $41 million in revenues this year, up about 88% from 2023. I like that.
Out of the four quantum pure plays, only IonQ and Rigetti are considered system-level players. Now, it is important to understand that there isn't just one form of quantum computing, but in fact, multiple approaches being experimented by different players. It remains unclear which technique will ultimately prove most effective and commercially viable, but currently the two main forms of quantum computing are superconducting and trapped ion. Superconducting is currently the most popular quantum computing approach, in which Rigetti Computing is competing against tech giants Google and IBM. On the other hand, IonQ remains the largest player in the trapped ion space and does not face any competition from any tech behemoths at present. Now, going into the scientific explanations of these two approaches could take unnecessarily long. For investors, it would be more useful to acknowledge some key strengths and weaknesses of the main quantum computing methods. A key concept to understand is coherence, which IonQ defines as coherence time, a measurement of the lifetime of a qubit. Coherence time measures how long a qubit can maintain coherent phase, which allows it to be successfully retain quantum information and behave in the ways necessary for it to be part of a useful computation. Keeping this in mind, one of the key advantages of the trapped ion approach is that it boasts longer coherence times, enabling better information retention and subsequently also lower error rates. On the other hand, the superconducting methodology is prone to easily losing coherence, particularly due to noise sensitivity. These systems also require extremely cold temperatures to function, whereas the trapped ion systems can operate at room temperatures. However, trapped ions qubits are slower than superconducting qubits, making the latter more valuable for processes and workloads where speed is of essence. Furthermore, Rigetti could also benefit from the fact that there is a broader industry-wide effort, including from Google and IBM, to make superconducting systems the prevalent form of quantum computing. Financial performance at first glance of the revenue trajectories of each of the quantum stocks, IonQ evidently stands out as a stellar growth stock. The trapped ion approach of IonQ possesses advantages that offer commercial value, and the company has garnered a track record of being able to effectively monetize its technology over the past several years. On the Q3 2024 earnings call, IonQ CEO Peter Chapman emphasized how the company is doubling down on commercial monetization. What are the applications that have the potential to disrupt multi-billion-dollar industries? Biopharmaceutical drug discovery and computer-aided simulations for the engineering and manufacturing industries. Its longer coherence times and relatively lower error rates are proving valuable for research workloads in biopharmaceutical and manufacturing industries. Given IonQ's fast-growing and largest revenue base relative to its pure quantum peers, it also grants the company the opportunity to continue building upon this lead by having more money to reinvest into the business and build more superior technology. On the other hand, Rigetti Computing's revenue trend has been more unstable and lumpy in nature. Rigetti Computing's main strength lies on the foundry side, as underscored by its contract with the Air Force Research Lab. Nonetheless, Rigetti has fallen short of producing consistent revenue growth the way IonQ has been delivering. Additionally, Rigetti also faces competition from tech heavyweights like Google and IBM in the superconducting space, which could undermine pricing power and profit margin prospects going forward. Whereas IonQ remains the leader in the trapped ion arena without facing competition from any big tech titans. Although despite Google and IBM likely promoting their own in-house quantum solutions through their respective cloud platforms. Nonetheless, both IonQ and Rigetti presently remain deeply unprofitable, with net profit margins of negative 458% and negative 510%, respectively. Although it is worth noting that Rigetti has been issuing new shares to raise fresh new capital and strengthen its balance sheet. The recent run-up in quantum stocks has led to extended valuation risk. However, the recent rally in these stocks has little to do with past performances. It has more to do with the improving prospects of future revenue growth as quantum computing gains more mainstream acceptance. This is AWS launches its Quantum Embark program, and Google boasts of the performance capabilities of its new Willow chip for quantum computing workloads. Furthermore, regardless of the predicted revenue growth rates, these ultra-high valuation multiples also make them vulnerable to steep corrections due to broader macro conditions. Most recently, the Federal Reserve signaled fewer rate cuts going into 2025. If inflation rates continue to rise higher, it is the risky growth stocks like the pure quantum plays that will be hit the hardest amid tighter monetary policy conditions. Moreover, at the industry level, quantum computing remains a nascent technology. It remains to be seen which technique will prove most effective and commercially viable. If investors are already questioning the high valuation multiples of AI-centric stocks as they wait for justifiable returns on investments, it certainly raises a bar for pure quantum companies as well. Many businesses are still organizing their data records and structures to be fit for company-wide AI deployments. So quantum computing is unlikely to be on the priority list of C-suite executives for the foreseeable future. As a result, the current high valuation multiples of the quantum stocks seem to be overestimating the technology's monetization potential over the near term, making them prone to steep sell-offs.